David Orguttery is the Chief Executive Officer of INSOURCE Financial Advisors of Lincoln, Nebraska. David Guttery and Seth Edgil are financial advisors who represent Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Welcome back, everybody. Joining me today is Seth Edgil, a financial advisor for INSOURCE Financial Advisors. Seth, thanks so much for being with us today. Well, we're reviving McDonald's once famous but always short-lived salads to explain a bigger economic mystery.
Exactly. Each time McDonald's surveys say customers want healthier options, salads appear on the menu. Yet sales lag, the salads vanish, and fries keep selling. What people say they want and what they buy rarely line up. We're seeing the same gap in 2025's economy. The problem lies in what people say is good for everyone in general is rarely what they choose for themselves.
To keep terms straight, soft data is what people tell pollsters, confidence, expectations, plans, while hard data is what shows up in cash registers, payroll reports, and bond auctions.
Right. The two stories don't match. The hard numbers are strong. March 2025 retail and food service sales reached $734 billion, up 1.4% from February and 4.6% from March 2024, per the Census Bureau. Payrolls are still expanding, and in several regions, wage growth is above inflation. Yet, soft data surveys describe customers bracing for recession.
Well, much of that gloom is political. How does the University of Michigan track this?
Their surveys of consumers show the same pattern every cycle. Sentiment rises among voters whose party holds the White House and falls among the opposition, while independents land squarely in the middle. Democrats and Republicans stay far apart, yet their confidence tends to move in parallel. Both sides bottomed in June 2022, improved through mid-2024, and slipped again after the January 2025 inauguration. During the Trump years, the correlation of the sentiment was roughly 0.85. During the Biden years, it was about 0.86. Inflation expectations follow the same dance, with each party worrying more when it is out of power. National sentiment isn't hijacked by one side, it mirrors independence, the group least swayed by partisan emotion.
Well, put that in real-time context for us.
When Donald Trump won in November 2016, confidence among Republicans surged, while Democrats' confidence plunged. Yet, independents and the overall index barely moved. The mirror image occurred after Joe Biden's victory in 2020. The pattern flipped again following the 2024 election of a Republican. Through it all, the three curves headed in the same direction. Politics drives the mood more than paychecks.
Well, meanwhile, the cash registers keep ringing.
Exactly. A 4.6% annual sales gain is hard to square with an imminent downturn. If households truly felt squeezed, packed restaurants and full flights would be rare sights.
So why do feelings stay so negative?
Part of it is simple human wiring. We remember bad news more vividly than good. Media outlets know fear attracts clicks, so negative headlines dominate. Add partisan identity, where we subconsciously judge the economy through our team's lens, and the gloom from surveys can drown out solid spending numbers.
What happens if investors treat survey gloom as gospel?
They may dump stocks in a panic and miss rebounds driven by real earnings. Or they might slash household budgets so sharply that demand finally falters and creates the slowdown they feared. Conversely, ignoring genuine red flags could leave them overexposed if hard data weakens later.
Was there upside for people who recognize this salad problem?
Absolutely. When sentiment disconnects from fundamentals, markets misprice risk. Staying data-driven lets disciplined investors scoop up quality assets during emotion-driven dips, lock in financing while competitors freeze, and lean into sectors such as travel and select consumer services where spending still outpaces headlines. Business owners can seize talent and market share while others hesitate.
Well, how should viewers put that into practice?
First, run a personal dashboard. Review your income security, debt, savings, and job prospects instead of outsourcing emotions to news feeds. Second, track neutral indicators like retail sales, non-farm payrolls, PMIs, and credit spreads so you're weighing facts, not fears. Third, keep your portfolio diversified and automate contributions. Steady investing usually beats headline time trades. Fourth, stress your finances under slower growth scenarios to see if you can still cover obligations. And finally, filter noise with professional guidance. If you'd like help tailoring a plan to your circumstances, you're welcome to reach out. I'm always glad to offer one-on-one advice.
Before we close, you have a disclosure to share.
Certainly. Everything we've discussed today is for general educational purposes only and does not constitute legal, tax, or personalized financial advice. Please consult a qualified professional regarding your own situation.
Well, Seth, as always, thanks so much for this information. And for additional information, Seth may be reached through the means listed upon the following screen. For INSOURCE Financial Advisors, I'm Brandon Dawkins.
David Guttery and Seth Edgil independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.